sometimes you just don't have the latitude to go out and see it. And when you get good at identifying the things that are most important in the property and knowing how to mitigate against the things that you don't see, then it just becomes commonplace to be able to buy places without ever seeing them.
I have 3 LLCs set up, and one is a home base, and the other one is a rental from the home base, and the other one is the properties. My question is with regard to the tax person, the person who does your taxes, the person who sets that up. Do you recommend a CPA, or is it just at the end of the year having a very knowledgeable and strategic tax preparer, or are they one and the same?
In my opinion, I think everyone's end goal should be to have a CPA. Okay. Now, you actually are in a position where you already have some business, so I definitely think it makes sense for you to get a CPA. For those that are literally starting out from ground zero, it may be a little more expensive than you would like when starting out with a CPA. Okay. So maybe you do work with a tax preparer for that first year. As you get your business going, then you move from a tax practitioner to an actual CPA. Okay. And the reason is because a certified public accountant understands the tax code and the tax law much different than somebody that just knows how to prepare a tax return. Okay. And so if that tax preparer is not a real estate investor themselves, there's a ton of deductions that they're going to miss based on your scope of business, unlike those of which, you know, they're normally standard dealing with, the standard of the people that they normally deal with. And so anybody that already has a property, a couple properties, who's on this call, I will highly recommend that you get to a point where you're using a CPA sooner than later. I always make the comment that my CPA don't cost me money, they save me. So on the front end, the sticker shock of what that may cost may be jolting, but when you look at the result of their efforts, it's like, oh my God, like I saved 3 times the amount that I paid them to do my taxes. So that would be my recommendation, especially if you got multiple LLCs, that you get to that point. And then, like, I'm fortunate, my CPA also is a tax attorney. So he understands tax law and tax code like nobody's business, right? And like the folks in my inner circle, they get access to him. Like he's phenomenal. I've been with him for almost 15 years now. Anytime you guys make an investment in coaching or training, if you have a tax preparer, they're not gonna know how to book that property. And it's not treated and viewed as tuition is in college. So in tuition, you can only write off a small fraction of that. So if you were somebody that had a W-2 job, and let's just say you made $100,000, okay? Or even if you had a business, you made $100,000. You're going to be taxed at the highest level because of the tax bracket that you're in, right? But then let's say you did what I did. You went out and got coaching, and now you got this business write-off of $55,000 against your W-2 salary. You're going to go from owing the IRS to now the IRS owing you money at the end of that year, from having the right people on your team that understand that investment that you made in yourself is an investment into your business, and it should be treated as such per the tax law.
What type of margins do you typically look for when you're doing a flip? Like what, like purchase price compared to the fix up value, like I wanted to ask that yesterday, because that's something that I'm working on trying to build for myself, an idea of that, because I do have some people that's interested in investing with me, but I want to make sure that I'm bringing things to the table with them, to kind of fit that style.
In our program, okay, I highly recommend to our students that they do a minimum of 25 to 30% gross profit on their deals. Okay, that's like a good benchmark to start, which means that if your purchase price in rehab is, say, $150,000 all in, you will want that deal to start out with a minimum of $45,000 in gross profit. But my short answer to that is, we start out with a minimum threshold of 25 to 30% gross profit, because that gives us enough latitude to where, for some reason, as we went through the due diligence process if it still wasn't a good flip for us based on margins, then we could potentially wholesale that deal because we got so much meat on the bone. If it was a good deal and we went through and all of a sudden interest rates went to 7%, as they just recently did, and the market started to slow down, if we needed to discount that property and get out of it, then we could do that and still be profitable. There's a myriad of reasons why, years of developing that number, before the market became what it was, it used to be a minimum gross profit of 20 to 25%, but after COVID, we kind of inched that up to 25 to 30% as a minimum gross profit to start from.
When purchasing remotely, which a lot of times you're going to have to do in order to expand the portfolio based on what you were saying yesterday and everything, is it necessarily a good thing per se to buy sight unseen? Unless you've already worked with, I guess, whatever contractor or inspector that you're sending out to the house?
If you've been trained to know what you look for, yes. Probably 60 to 70% of the deals that I buy, I never see before I buy. And not because I plan it that way all the time, but it just oftentimes works out that way because it was so funny how back when I was flipping houses heavily, like 20, 30 deals at a time, I was sitting in my house in Florida at the time, and I was killing the competition in Detroit, and they were there physically, right? And so with that being said, success loves speed. That's why I'm constantly reiterating all week, are we going to take action immediately? Are we going to, because I'm not confused. And so I say all that to say, sometimes you just don't have the latitude to go out and see it. And when you get good at identifying the things that are most important in the property and knowing how to mitigate against the things that you don't see, then it just becomes commonplace to be able to buy places without ever seeing them.